Hey there, fellow investors and future finance gurus. Welcome back to the Investing Iguana, your go-to spot for demystifying the complex world of investments. I'm Iggy, and today, we're embarking on a timely adventure from NPV to REITs, mastering investment strategies in uncertain times. The Investing Iguana is featured and ranked 8th in the 2023 Influential Tigers by Tiger Brokers. In this video, I'll break down how understanding net present value, NPV, and the movements of interest rates can arm you with the knowledge to navigate through the stormy seas of today's market. Whether you're looking to dive deep into value investing or wanting to understand how REITs adjust sales in fluctuating financial climates, we've got you covered. So, if you're ready to turn the uncertainties of today into the strategic victories of tomorrow, you're in the right place. Let's decode the secrets of making informed investment choices together. Net present value, your financial time machine. Let's dive a little deeper into the concept of net present value, NPV, which can be thought of as your very own financial time machine. Imagine you have the ability to travel through time, specifically into the future. You are interested in making an investment and you want to know how much the returns from that investment will be worth in today's terms. This is where NPV comes into play. It's a financial concept that allows you to calculate the value of future money in today's terms. Think of it as a tool that gives you the power to predict the worth of your investment returns. You're not just looking at the raw numbers of what you'll earn in the future. Instead, you're considering the value of that money in today's terms, taking into account factors like inflation and the cost of capital. This concept is particularly valuable for value investors. These are investors who are always on the hunt for the best investment opportunities. They're looking for companies where the market capitalization, the total value of all a company's shares of stock, is lower than the NPV of its future cash flows. In other words, they believe the company is undervalued by the market. Crunching the numbers on NPV. Let's break down the process of calculating net present value, NPV, which might seem complex at first, but is actually quite straightforward once you understand the components involved. Firstly, you need to know how much money you expect to receive in the future. This could be the returns from an investment or the revenue from a business project. These are your future riches that you're trying to evaluate. Secondly, you need to know when you'll receive this money. The timing of future cash flows is crucial in NPV calculations because money received sooner is worth more than money received later due to the time value of money. The third component is the discount rate, which acts like your financial compass. This rate is used to discount future cash flows to present values. It takes into account the risk and opportunity cost associated with the investment. The higher the discount rate, the lower the present value of future cash flows. The discount rate helps us compare future riches with today's treasure chest. It's all about understanding if $1 today is sweeter than $1 tomorrow. In other words, it helps us understand the time value of money, which is the principle that money available today is worth more than the same amount in the future due to its potential earning capacity. Interest rates, the economy's heartbeat. Interest rates can indeed be thought of as the heartbeat of an economy, influencing a wide range of financial decisions and strategies. Low interest rates are often compared to sunshine for growth stocks. They create an environment that encourages investors to dream big and invest in the future earnings of companies. This is because when rates are low, borrowing costs are also low, making it cheaper for companies to finance new projects and expand their operations. As a result, the potential for future earnings increases, making these companies attractive to investors. On the other hand, higher interest rates can bring us back to earth, so to speak. They increase the cost of borrowing, which can slow down economic growth. For investors, higher rates can make the immediate gratification of short-term gains more appealing. This is because the returns on investments that offer a fixed return become more attractive compared to the riskier prospects of growth stocks. This fluctuation of interest rates, much like a seesaw, influences everything from our stock choices to how real estate investment trusts, REITs, manage their finances. REITs, for example, often rely on borrowing to purchase more properties and generate more income. When rates are low, this strategy can be very profitable. However, when rates rise, the cost of borrowing increases, and REITs may need to adjust their strategies. REITs, navigating through financial storms. Real estate investment trusts, REITs, can indeed be likened to large ships navigating through the changing tides of interest rates. These entities are required by law to distribute most of their cash flow as dividends to their investors. This makes them attractive investment vehicles for those seeking regular income. However, this characteristic also places REITs in a challenging position when interest rates rise. Higher interest rates increase the cost of borrowing, which can affect REITs that rely on debt for their operations. This is often referred to as the whirlpool of refinancing. When caught in this whirlpool, the profitability of REITs can be affected, which in turn impacts their allure to investors. A recent example of this is Manulife US REITs. The REIT's portfolio valuation fell 14.6% to $1,633.55 million from $1,913.5 million as at December 31, 2022. This was attributed to higher discount rates and terminal cap rates for certain properties, as well as continued weakening of occupancy across the U.S. This led to a breach of its existing financial covenants, affecting its ability to pay out distributions. The REIT's net asset value declined by about 7 cents per unit. This example showcases the real impact of financial forces, such as interest rate hikes, on REITs. It underscores the importance for investors to understand these dynamics when making investment decisions in the REIT market. As with navigating a ship through a storm, careful and informed steering is key to reaching your destination safely. Looking ahead, forecasting financial weather. Forecasting the financial weather is a crucial part of investment strategy, and movements by the Federal Reserve play a significant role in shaping this landscape. When the Federal Reserve signals potential rate cuts, it can lead to a rejuvenation of the investment landscape. Lower interest rates can stimulate economic growth by making borrowing cheaper. This can be particularly beneficial for growth stocks and real estate investment trusts, REITs, which often rely on borrowed funds for their operations. Growth stocks, or companies that are expected to grow at an above-average rate compared to other companies in the market, can benefit from lower borrowing costs, which can help fuel their expansion. Similarly, REITs, which often use debt to finance property acquisitions, can also benefit from lower interest rates, as it reduces their cost of capital. The market's reaction to these anticipated movements is often immediate. For instance, REITs may rally in anticipation of rate cuts. This highlights the close watch investors keep on these financial indicators. It underscores the importance of staying informed about economic trends and understanding how they can impact different types of investments. And that wraps up our journey from understanding NPV to navigating the ebbs and flows of REIT investments in these unpredictable times. We've seen how the mechanics of future value and interest rates are not just theoretical concepts, but practical tools in our investment toolkit. From evaluating potential investments with NPV to assessing how REITs can fit into your portfolio amidst changing interest rates, it's clear that being informed is your best defense against uncertainty. If this exploration has equipped you with valuable insights or sparked your curiosity to learn more, why not give this video a thumbs up? Better yet, subscribe to the Investing Iguana for more finance wisdom and strategies designed to keep you ahead of the curve. Have thoughts or questions? Drop a comment below. Let's keep the conversation going and grow our community of savvy investors. Until next time, remember, in the world of investing, knowledge is not just power, it's profit. Stay savvy, and see you in the next video.